Forward contracts are derivative instruments that obligate two parties to transact an asset at a predetermined price on a future date. The agreed-upon delivery price established at contract initiation is known as the forward price. A key principle in forward pricing is that the contract should have zero value when initiated because neither party pays for entering the agreement. The distinction between price and value is important. The forward price is fixed at initiation, whereas the value of the contract changes over time as market conditions evolve. Arbitrage-free pricing ensures that forward contracts are fairly priced relative to the underlying asset and prevailing interest rates. The foundation of forward pricing is the no arbitrage principle. Investors should be indifferent between purchasing an asset directly today and creating a synthetic position through borrowing and future delivery arrangements. This relationship leads to the cost of carry model, which states that the forward price equals the current spot price adjusted for financing costs and benefits associated with holding the asset. Financing costs include interest expenses incurred to purchase the asset, while benefits may include income generated by the asset before delivery. If forward prices deviate from arbitrage-free levels, traders can exploit the discrepancy through cash and carry or reverse cash and carry arbitrage strategies. The value of a forward contract after initiation depends on the difference between the current forward price and the delivery price specified in the contract. If market conditions change such that the agreed delivery price becomes favorable relative to current forward prices, the contract gains value for one party and loses value for the other. A long position benefits when the underlying asset's value rises, while a short position benefits when it falls. As a result, forward contracts create a zero-sum relationship between counterparties. Understanding how forward values evolve over time is essential for pricing, risk management, and derivative valuation. Equity forwards are forward contracts written on individual stocks, stock indices, or equity portfolios. The arbitrage-free forward price for an equity forward depends on the current stock price, financing costs, and expected dividend payments during the life of the contract. Because dividends reduce the future value of stock ownership, they lower the forward price relative to an otherwise identical non-dividend paying stock. Investors who purchase the stock directly receive dividends, while forward contract holders do not. Consequently, expected dividends must be incorporated into pricing models to ensure that forward contracts remain consistent with no arbitrage conditions and accurately reflect economic ownership. The valuation of equity forwards after contract initiation follows the same general principles as other forward contracts. The contract's value reflects the difference between the market forward price and the delivery price agreed upon when the contract was established. Changes in stock prices, dividend expectations, and interest rates can all influence contract value. For a long equity forward position, increases in stock prices generally create gains, while declines create losses. Because equity forwards provide exposure to stock price movements without requiring immediate capital investment, they are widely used for hedging, speculation, and portfolio management purposes. Fixed income forwards are contracts based on bonds or other debt securities. Their pricing incorporates the current bond price, financing costs, and any coupon payments expected before contract expiration. Since bondholders receive coupon income while forward holders do not, expected coupon payments reduce the forward price in a manner similar to dividends on equities. The forward pricing model values fixed income forwards by applying arbitrage arguments that equate direct bond ownership with a synthetic position involving borrowing and future purchase agreements. This framework ensures that forward prices remain consistent with observable bond market prices and prevailing interest rates. The valuation of fixed income forwards changes as bond prices, interest rates, and coupon expectations evolve. A long forward position gains value when bond prices rise above the contract's delivery price and loses value when bond prices fall. Interest rate movements are particularly important because bond prices generally move inversely to yields. Declining interest rates tend to increase bond prices and therefore benefit long forward positions, while rising rates have the opposite effect. These relationships make fixed income forwards valuable tools for managing interest rate exposure, implementing market views, and hedging bond portfolios against changing economic conditions. Forward pricing and valuation concepts provide a unified framework for understanding derivative markets. Whether applied to equities or fixed income securities, forward contracts derive their prices from no arbitrage relationships that link spot prices, financing costs, and asset-generated cash flows. The distinction between forward price and forward value is fundamental because contracts evolve in value after initiation as market conditions change. Equity forwards require adjustments for dividends, while fixed income forwards account for coupon payments. Mastering these concepts enables analysts to value derivative instruments accurately, identify arbitrage opportunities, manage financial risk, and understand the role of forward contracts within modern investment management.